All right, as you are aware, Iran was attacked over the weekend and conflict is spreading in the Middle East. It looks like we are on the precipice of World War III, so how should you invest? Well, the first thing you should do is pause. There's a chance that conflict in the region may have already peaked. The best signal we have for this is how the stock market has performed this morning. The Dow Jones opened down more than 500 points, though at the moment is down less than 100 points. Stocks such as Nvidia opened lower and have reversed to trade higher. Nvidia opened lower 1.5% and currently is trading 2% higher for the day. There is an alternate scenario, and that scenario is that this attack in Iran was already priced into the market. How could that be? There were tells that this attack was somewhat imminent, and astute investors may have already priced this conflict into the market, meaning if you are looking to sell today, there is a chance that you may be selling into a short-term bottom. Now, with that said, who knows? Who knows what can happen? The Middle East is a modern-day powder keg, and there is the possibility for this regional conflict to expand and become much more significant in scale, which does have the possibility to bring down stocks more in the upcoming days, weeks, and months. So, with this lack of visibility, how should you invest in stocks? You are probably thinking about the stock market in conventional terms right now, which is either buy or sell. However, there is a third option, and that third option is to hedge your stock investments. There are two main verticals to hedge. The first option is where you pay to hedge. The second option is where you get paid to hedge. They function very differently from one another. The first vertical is where you pay to hedge. This is where you pay a premium. Think of paying an insurance premium. And in this case, you pay a premium whereby if stocks fall, then you can sell your stocks at a certain specified level, meaning that your downside loss exposure is confined. It's defined to a certain amount to the downside. And once you've achieved that maximum loss exposure, you have no more additional loss exposure. The benefit to this is that you maintain unlimited upside appreciation potential that you can benefit from less the cost of the insurance premium or the hedging premium that you paid, which serves as a drag against performance. The second way to hedge is where you actually get paid to hedge. In this scenario, instead of maintaining unlimited upside appreciation potential, you limit your maximum upside share appreciation potential. What happens is you own stocks and then you sell away unlimited upside potential, meaning you sell somebody the option to buy your shares from you at a specified higher price, and in exchange for doing so, you receive hedged income. This hedged income is yours to keep regardless of whether stocks rise, remain unchanged, or fall. You keep this income so long as you maintain the investment exposure until the hedge expiration. The hedge expiration can be measured in hours, days, weeks, months, or even 1 to 2 years. The benefit for this strategy is that you receive hedged income, and if you extend your investment horizon significantly beyond 1 year, then not only are you achieving tax efficiency in this structure, but also you receive premium that is so significant that if stocks rise or remain unchanged, you can generate really compelling returns. And in the scenario in which stocks fall, you receive hedged income, which then converts to serve as a buffer of downside protection, meaning that if stocks fall, you incur no losses until that hedged income has essentially been exhausted, and then beneath that threshold, then you have loss exposure. If you'd like to better understand that second means of hedged stock investing, then check out a video I posted a few days ago here, which summarizes a 2-year customized hedged stock portfolio. This portfolio generates hedged income of 27.1% over a 2-year investment horizon, which means that if stocks rise, remain unchanged, or fall over 2 years, you keep this hedged income of 27.1%. If stocks are unchanged for 2 years, you keep 27.1%. If stocks rise, the trade-off is that your upside potential is limited to or maximized at 30.1%. In the event that stocks fall, you have downside protection of 27.1%. That hedged income you receive of 27.1% serves as insulation to the downside if stocks fall, meaning that if stocks fall 27.1%, the hedged income you receive buffers that downside, meaning you don't have a loss. Below 27.1% loss exposure, then your loss exposure for the portfolio begins. If you'd like to see other portfolios, go to our website at bespoketfc.com. And if you have any questions or comments, because hedged stock investing is most likely a new concept, then leave your thoughts in the comment section. Thank you for watching.